Hi, my name is Jordan Wilson. Today we're going to continue looking at the lump sum versus dollar cost averaging debate with a focus on some potential upside to dollar cost averaging. And the focus here is going to be primarily on market volatility. So in the last episode we said, which is better, lump sum investing, dollar cost averaging? And we saw that over time, lump sum investing will outperform dollar cost averaging. But it wasn't that simple. Yes, in the long run, markets appreciate. Asset classes grow in value over time. But that's the long run. In the short and medium term, there can be lots of market volatility. And as we saw when we looked at investment risk and standard deviation, it's that volatility that's the riskiness of an asset. And the greater the risk of an asset, the greater its volatility will be, as measured by the standard deviation. So perhaps dollar cost averaging can provide some risk management, especially dealing with the more volatile asset classes like equities. So we saw the big advantage of lump sum investing is that assets appreciate over time. The sooner that you purchase that asset, therefore, the longer you have in a time period for it to appreciate and grow. So I'm better off buying 100% of shares in Amazon or Apple or Google on day one, as opposed to spreading those purchases over a 1 or 2 year period. Now that assumes you have the capital up front to make that purchase, which many people don't, but again, that's the premise behind lump sum investing. And it dovetails well with many investor financial objectives. For many, a key objective is retirement. And if you're 20 or 25, that might be a 40-year, 50-year time horizon. Great. Even if you're in your 30s or early 40s, kind of that sweet spot to have disposable income to invest, you still probably have a 25-year time horizon, which is quite lengthy. One of the problems, though, is that when we talked about financial objectives as part of the investor profile, I mentioned that all investors will have short, medium, and long-term goals. I want to buy a house in 2 years. That's a short-term financial objective. I want to pay for my daughter to go to university in 12 years. That will be a medium-term objective. So not all of an investor's financial objectives are going to be 40 years in time horizon. They're not all retirement related. As well, the 25-year-old in 5 years is now 30. In 10 years, 40. Time shrinks for people. So what was a long-term objective 10 years ago is now medium term, and soon it'll be short term. So this is something to keep in mind. And when we look at the markets, yes, they grow over time, but in that short to medium term, there can be lots of volatility. And that kind of leads to the second potential advantage of lump sum investing is the ability to engage in market timing activities. If you believe the market is overheated, you don't buy. You hold off, waiting for a correction to come. And as we'll see in a couple of examples coming up, over the years, there is a lot of market volatility that one can take advantage of. Yet when we looked at how active asset managers are unable to consistently outperform their benchmarks over longer periods, one of the issues that led to that underperformance is their inability to accurately time market movements. And we looked at a few slides where even if you missed 5 or 10 best days in a period, that had huge impact on your cumulative growth in your portfolio. So market timing and the inability of professional investors to correctly call the movements was a big problem for them to try to match their benchmarks. So the question for you is, okay, you've got your 10 grand. Do you know when the right time is to invest it? Hopefully you do, but the track record of the professionals is poor. So I doubt that you're going to have a lot more luck. Now, if we look at this graph, this is the Dow Jones Industrial Average from basically inception, say 1915, all the way up to the end of 2020. And I've backed it out from inflation, so we've just got hard data. It's usually better to look at it with inflation factored in, but we're just going to look at the numbers. Now, this kind of proves the lump sum investing advantage. If I bought in 1915, by 2020, I've made some nice progress, some fantastic progress. And even if I had bought at the very peak in the summer of 1929, and if you look at that sharp drop on the left, that's sort of 1929 to 1932. If I bought at 1929's peak, the market fell 89% thereafter. But over a longer time period, I still was turning a net gain. And it almost becomes market noise if I compare that drop in 1929 to where the markets are in 2021. But even on this graph spread out over so much time, you can see the volatility. Market goes up, market goes down, market goes up, market goes down. The long-term trend is up. But how does that short-term volatility impact your short to medium-term financial objectives? Here we look at 1915 to 1960, and we see that 89% drop from 1929 down to 1932. The thing to note here, again, besides the general volatility, is that it takes time for things to recover. So if you'd bought even at the peak in 1929, you've done okay by the end of 1960. Done much better if you timed the market to 1932, but nevertheless. However, if we scroll across that line, what you'll see is that had you bought in 1929, it would have taken you until 1954 to get back to your break-even point. 1929, let's say 1930 to 1954, there's almost 25 years. That's long term. Can you afford to wait 25 years to get back to the break-even point? Do you plan to live till you're 150, where you can see that cumulative long-term growth kick in? So that's an issue. In this graph, we just sort of moved from 1915 to 1960, and now we're in 1960 to 1990. A lot of short-term, medium-term volatility, especially between, say, 1965 and mid-1980s. In fact, the Dow kind of ebbed and flowed between 1965 and 1983, and it didn't actually increase. So we're looking again at maybe 20 years of flatness. And yes, if you were prudent enough or sharp enough to jump in 1969 and then again in 1974, you could have made money. But if it's that easy, again, why are not the active fund managers, the professionals, jumping in and out like jackrabbits and reaping the benefits of all that volatility? It's difficult. So again, we've got a 1965 to 1983 20-year period. Is that short-term volatility or is that longer-term volatility? In this slide, we just continue on 1990 to 2020. And we see again that long-term trend of growth. But we also see, again, some fluctuations. And we see that in October of 2008, for example. On October 1st, the Dow traded up to 11,022. By October 10th, it had fallen to 7,774 before closing the day at 8,451. So in 10 days, it fell 29.5%. If you had timed things properly, you'd have done well. But if you hadn't, if you'd bought, say, in 2000, again, you're looking at a very flat profile. And that's part of the problem, again, is that in the long term, trend is up, but in the short term or medium term, we've got other objectives. We've got other goals that we need to ensure that we meet from a financial perspective. And that's maybe the problem with lump sum investing, is that we don't have 100-year time horizons. At most, we might have 50, but then we age and it's 40, then it's 30. And we also have the short and medium term goals. So again, that's the problem, I think, with lump sum investing. It works, but it's not without its problems. We come back to the question of which is better, lump sum, dollar cost averaging. Clearly over long time periods, lump sum. But the problem with that is, one, Most investors don't have 100% of the capital to invest on day one. You want to invest $12,000 in a company, there's a good chance you won't have $12,000 just sitting around. You'll have to accumulate it over a period of time to make the purchase. And then you start getting into the behavioral issues of when should I buy? What's the media saying about the economy? The 2008 financial crises, the 2016 Donald Trump election. There's a lot of noise out there, and part of the media function is to amplify that, to draw clicks to their websites, sales of their magazines, etc. And that's not necessarily bad, that's just the way it's always been. But there's a lot of noise that clouds one's judgment on when to invest. So that's an issue. Another issue with lump sum investing is we don't all have 50-year time horizons. We have short-term, we have medium-term objectives. Plus each passing year turns that 50-year time horizon into a 40-year to a 30-year. And as we just saw in some of the previous slides, that market volatility, or the down markets, can often last 20 to 25 years before you get back to the break-even point. That's an issue. Now, dollar cost averaging doesn't really help with some of that stuff I've just talked about. I mean, once you've bought your investment, you've bought it. I want to invest $12,000 in a company on day one. Fine. I buy it either January 1st or I wait till I think it's the right time to buy, and I invest everything. Now, if the markets go down, that's problematic. But if I went out and I spread that $12,000 over 2 years, investing every 2 months an equal amount, once I've amassed that investment, if the markets crash, I'm still in the same position as the lump sum person. I have to ride that out. But where dollar cost averaging can help is managing some short-term volatility when you're buying. So if we look and we buy on day one a lump sum $12,000 investment, and let's say the shares are trading at $12 a share, so I buy 1,000 shares. Great. Now I have to ride that up and down as the markets move. But if I decide to buy that over 24 months at $500 a month, or $1,000 every 2 months, then if the market starts to fall from 12 to 10, that $1,000 bi-monthly, I'm now able to get $1,000 divided by 10, 100 units. 100 shares. If it falls to 8, I get more. If it falls to 6, I get more. And then when it bottoms up and starts to rise up again, that fixed amount that I'm allocating every month or two to make my purchases buys proportionately less as the share price rises. So what you find in a volatile market is that you're able to smooth out your purchase pattern. So you're not taking the chance of buying at the peak or getting lucky and buying at the bottom. You're just saying, okay, over the next 2 years, I'm going to end up buying at the average price at the month end or by month end. And that's what I get. And you find out you smooth your investment patterns. And the advantage of that, and we'll get into this in future episodes, is that you smooth out your cost base, which is a good thing. But you also improve your investment discipline and consistency. You tune out the media noise, the market noise, and you just say, every 2 months, I'm investing $1,000 in this asset. And it's not, oh, what's happening in the US elections? What's Joe Biden going to do to the markets? Or what's happening in Canada with the Liberal Party? It's just, here's my game plan. It was a sound and prudent game plan when I developed it, and we're just going to tune out all the noise and implement it. So I think that's another big advantage that we'll get into with dollar cost averaging. So there's more to it than just the pure financial side. It helps keep you a little bit disciplined, consistent in your approach and process. And I think those are big benefits for many investors. So again, maybe the numbers over the very long term make lump sum investing preferable, but in the short to medium term, we just saw a lot of volatility and a lot of risk areas. And this is an area on the market volatility side where dollar cost averaging can help investors both on a financial side, but also on an emotional and behavioral side. That's all we want to discuss today. Again, we saw that market volatility is significant and can be prolonged in the marketplace. So don't just think market volatility is sort of a 6 to 12 month issue. It can extend over periods of time, and it's prudent to take steps to try to manage that volatility and manage that risk. And especially when you get into higher volatility assets like equities, because the greater the volatility, the greater the market movements. So we'll come back in the next episodes, look a bit more at dollar cost averaging from a few different perspectives. Thank you for your time today. Have yourself a good one.